All right. So thanks for coming. And I have the privilege of doing this seminar with Ron Ricard, who I've once before done, and we had a great time. And the feedback was really good. And actually, people at the seminar thought we had known each other for years and years because it flowed so well. And and they were surprised to hear that it was the first time I'd really ever met him. But it really went well because they're two great subjects, kind of packed subjects. So anyway, let's talk about Prop 19. So Prop 19, as you know, was a proposition, very controversial in some ways, that passed in the 2020 election and actually took effect, I believe, in mid-February of 2021. Okay, so it actually simplified a bunch of things, and it made a couple of things a little more complicated. So we're going to talk today about the part that has to do with your property tax base. The rules are pretty simple, and they were expanded because of the wildfires that we had and natural disasters that everything was going on at that time, as you remember. So the new Prop 19 rules regarding taking your property tax base from a house that you've just, a residence, that's the important thing, a residence you just sold, and going to a new residence, is you have to be 55 or older, or severely disabled, or a wildfire victim, and or a natural disaster. It's really interesting, as she said, I'm retired. I got a call out of the blue today from a gal and she wanted to know if I still did taxes. I referred her to somebody who did, but I asked her, well, is there something unusual? And she said, yes. Our house was burned in the wildfire in 2020 up north, and the insurance paid them some money. They took a bit of a loss, and now they've 4 years, almost 4 years later, sold the land. So now they want to kind of figure out what the capital gain situation is. So this Prop 19 is applicable to them if they wanted to use it. It's all a matter of timing, though. It's been 4 years, so is there a special rule regarding that? I don't know. They'd have to kind of look that up. But anyway, 55 or older, and then those other classes of people. And so, again, it's just the tax base. And the other thing that Prop 19 did for us was that in previous law, if you sold in one county and wanted to move to another county, you had to first find out whether that county was cooperating with your county with regard to sending the property taxes over. Prop 19 said that's no longer the case. You can move to any county in California, and they're mandated to allow you to transfer your property tax base. There were a lot of counties in the foothills who frankly didn't want Bay Area people moving up there. So they made it as hard as possible by not allowing them to transfer their property taxes. And Prop 19 basically did away with that. Okay, so that's the basic idea of Prop 19. Now, two things regarding Prop 19 also had to do with whether or not you bought a property that was equal to or less in value than the one you had, or one that was more in value. So let's just say, and there's an example here on one of the pages, you bought a house for $110,000, it's now worth $200,000. I'm sorry, the property tax base is now $200,000 because over the years it increases little by little, and the value's $600,000. So, all right, so if you take that and you say, okay, I just sold my house for $600,000, it has a $200,000 base. Now, obviously, it's 1.1, so it's going to be like $220,000. So what happens? If I buy another house for $600,000 or less, I have the opportunity to then take my property tax base from property number one and move it directly into property number two. Now, why do you say opportunity? Because there may be situations where you don't want to do that. If the property you buy has a lower property tax base than the one you had before, then obviously you're just going to take the new property tax base on if you downsize that much, okay? But otherwise, you'll carry that $200,000 property tax base from property number one to property number two. Very simple. Now, the other situation is and I think it's here, if you've sold for $600,000 and bought for $700,000, it's very simple there too. You take the difference between the 6 and the 7, which is $100,000, and add that to the base that you had before in the old house, which was 2, so now it's 3. So now you have a $300,000 base times the 1.1, and your property taxes will be roughly $3,300 a year. So those are the two basic rules for Prop 19. One before and one after in terms of the value. Moving right along. Okay, so how often can you use this? Okay, so in prior law, if you were 55 or older and you used it, then that was it for you. You couldn't use it again. Now, I've had situations come up where I had a person who was previously married and they used it, and then the spouse passed away and the person remarried, and then they had another house and they wanted to use it again. Well, they were not allowed to use it, even because the gal had never used it before, but her husband had used it in a previous marriage or in a previous property. So that couple was what's called tainted. They were not able to use it. However, with Prop 19, you can use it 3 different times. So if that couple were still here today, because the husband had passed away at this point, they could have used it one more time, and the wife would have still had one more time that she could use it for a further principal residence later on. So this is a little bit more flexible with regard to the property tax base, moving it over and over and over. Okay, so again, as Gene had said before, this relates only to the property tax base for property tax purposes. It has nothing to do with capital gain. It has nothing to do with exchanges, so on and so forth. Okay. All right. Additional notes. Gains. Okay. All right. Good. All right. So, and the last point is that you have to do it within 3 years. You have to file it with the county within 3 years. So, I was thinking the other day, okay, because my mind always kind of runs. So, and by the way, it's 2 years before and 2 years after. So if you sell your house, the one that has your current residence, you have 2 years before to buy a home and have it count, or 2 years after, unlike the old law, which was you had different levels. So it came to mind that, okay, let's just say that you found a place and bought it and moved into it, and then 2 years later sold your principal residence that you had been in before. I don't think the county had really expected you to leave that first house vacant. Potentially, maybe if it's rented for a while, but you sold it within 2 years, that might qualify for the property tax base to be carried over. I know it's kind of a gray area, so I would say if that's something that you want to pursue, I would definitely talk to the county assessor's office before you do it and get for sure whether or not that's going to be a problem or not. And I'm sure your tax professional will also be able to help there. Okay?
It's the county you're going to that you want to check.
Pardon me?
It's the county you're going to that you want to check with.
Yes. The target county that you want to check for. So if San Mateo, you don't call the San Mateo assessor's office if you're going to move to Tuolumne County. You want to call Tuolumne County and say, hey, listen, I bought a house here 18 months ago, and I've just sold my old principal residence. Can I transfer my tax base? Because Prop 19 says I could do it if it's within 2 years. And they'll say yes or no. And then you might want to continue and say, well, does it matter what the status of the house is now? In other words, if it was rented, if it wasn't rented, because I can't expect that they would have you keep it vacant for 18 months just looking for a home. Not looking for a home, you already have a home, just looking to sell it. So anyway, just a thought. That's it.
Thank you. So we're going to have, so that's the intro to Prop 19. We're going to have Ron Ricard, my favorite 1031 person, going to come out, and he's going to be, thank you. Thank you, Joe. So just trying to make sure to give everybody the background. There's a lot in the slides as well, but so Ron's going to go ahead and discuss. Do you want a mic as well?
No.
Okay, so he's going to be
I'm
talking
louder than
about
he is.
1031 exchanges, and then we'll have Joe and Ron come up and talk about the different strategies.
How are you doing? How's everyone doing today? How's the food? Good. All right. Fantastic. In your package, one of the things that was not included is information about 1031 exchanges. I do have a few brochures up front there, so if on the way out you want to grab one of these or my business card, you are more than welcome to do so. Anyway, my name is Ron.ricard. I work for a company called IPX, or Investment Property Exchange. We are what is known as a qualified intermediary. How many people in this room have ever done a 1031 exchange? A few of you, fantastic. I know a couple of you actually have worked with us, which is great. I've been doing this for over 20 years, and actually this is an outdated slide. I've now been involved in almost 23,000 exchanges during my 20 plus years. So I've been doing this for quite a long time. Our company is owned by the same company that owns Chicago Title, Fidelity Title, Lawyers Title. We're actually the nation's largest intermediary. And so we basically, the reason I was saying that is because our job is to hold your money. So you want to make sure that the money is safe, and that's something we can do. Anyway, what is a 1031 exchange? 1031 just refers to a section of the tax code. It's a section of the tax code that says when you own a piece of investment real estate that you want to sell and buy a replacement piece of investment real estate, you can do so and defer paying your capital gain taxes. So what does that mean in English? You have a rental house. It's been a rental for the last 20 years. You want to sell that and buy a fourplex. So you call Gene, you list the property. At the close of escrow, the money comes to a third party called the intermediary, that's us. You then go ahead and get into contract to buy the replacement property. We send the money to the title company on that side, and the property closes. In the eyes of the IRS, you sold a piece of investment real estate, and you bought a piece of investment real estate. And because you didn't touch the money, because we had it, you get to defer paying taxes on the profit that you've made. No back. All right, so now obviously the key here is that you are deferring paying taxes. Now, that's also an important word, defer, not eliminate, okay? So if I sell my house to buy a fourplex, later I sell the fourplex to buy a sixplex, now I'm old and cranky and said, the hell with it, I'm just selling it, and I sell that sixplex, then you pay taxes from the house, the fourplex, and the sixplex. You are just deferring the taxes. Sometimes people will ask me at this point, well, why bother? I'm gonna have to pay the tax man anyway, right? No. Two reasons we always want to do an exchange. Number one, do you want to pay your taxes today or tomorrow?
Tomorrow. Tomorrow
is the right answer. The way I look at it is this. If I make $300,000 of profit on a property, I'm going to have to pay $100,000 of that in taxes on average. But because you get to do the exchange, you don't have to give the government that $100,000. You could take that money and buy more real estate with it. But the real reason you do the exchange is when do you really want to pay your taxes?
Never.
Never is the right answer. And guess what? You don't have to. Because sadly, one day, we're all going to die. And when you die, you win. Well, be honest. When you die, your kids win. Because when you die, your heirs get what's called a step up in tax basis. Make sure we all understand this. I bought a property many years ago for $100,000. Today it's worth $1 million. If I sell it, I have a $900,000 gain to pay tax on. But the day I die, whoever inherits the property from me, their basis of the property is the value of the property the day I die. If your kids are like mine the day after my funeral, they're selling everything. So when they sell it for $1 million, how much capital gain taxes will they have to pay? Zero. It's worth $1 million when I die. That becomes their basis. They sell it right away. They have no gain. All the taxes that you would have paid disappear when you die. That's the real beauty of the 1031. That's why the motto of our industry is swap till you drop. Just keep exchanging. Now, important thing to note, please do not give your real estate to your kids before you die. Because when you give your real estate or you add your kids a title, you are giving them your tax problem. You're giving them your tax basis. This only works if you are inheriting the property. So I know it's very common for people sometimes to think, well, I'll just add the kid to title. That way when I die, they just get it. Wrong. It's never a good idea to add your kid to title on a property for a variety of reasons I'm not going to get into today because I only have 2.5 hours to talk today. But the worst part of them is they don't get that stepped up basis by doing that. So it's much better for them have a trust. I think she'll have a trust attorney here speaking shortly. Have a trust. Have your kids as the beneficiaries, and that way they'll know what they're going to inherit. They get a stepped up basis, and everybody's happy. All right. Now,
You often will hear the term in 1031 exchanges as like kind. These are often referred to as like kind exchanges. Like kind is a very misleading term. Like kind is any kind of investment real estate for any other kind of investment real estate. You could sell a rental house and buy a shopping center. You could sell a farm and buy an apartment building. You could sell bare land and buy a rental house. Any kind of investment real estate to any other kind anywhere in the country. That term like kind goes back to many years. Anybody have a clue how long we've had 1031 exchanges? How long have we had 1031? How long has it been part of the tax code? 1921. That's older than anybody here, I'm going to guess. Okay? And considering we've only had income taxes since 1918, that's a long time. Okay? So the whole idea here is that back then you could do exchanges on anything, including stocks. Remember 1929? It changed after 1929, not on stocks anymore. But in my 20 plus years, I've done exchanges on airplanes. I've done exchanges on farm equipment. I've done exchanges. I did an exchange once for a guy who sold a FedEx delivery route and bought a UPS delivery route. That was a like-kind exchange. If you sold a boat, you have to buy a boat. You sold a piece of art, you have to buy a piece of art. In 2017, Congress rewrote the tax code and completely eliminated all 1031 exchanges, except real estate. So now 1031 exchange is only about real estate. And that term like kind is really irrelevant now. Because for us, now all we care about is investment real estate for investment real estate. Now, I did say though it has to be investment, so what is not investment real estate? Obviously your primary residence is not investment real estate. We'll talk more about that later. Same thing with second homes. Flipping real estate is also not investment real estate. Same thing with development. If you buy something, fix it up and sell it, or build a house and sell it, that is considered property purchased for resale, not property purchased for investment purposes. Okay? As a rule, investment real estate is real estate we get rental income from, or we run a business from, like if Jean buys her building that she runs her real estate company from, that's a business she's running from. Bare land is considered to be investment because it's considered to be held for appreciation purposes. So even if you're not getting income, land is still considered to be investment. But land is really kind of a special category about that. As a rule, if we're talking residential real estate, we're talking rental properties. But the key here, again, any kind of investment for any other kind, and we'll talk about the rest of these a little bit later. Now, there are two things you always want to know when you're doing a 1031 exchange. How long do you have and how much do you need to spend? Real simple. You have 45 days from the close of escrow to tell us what you're going to buy, and 180 days to actually buy it. 45 days to tell us in writing exactly the address to the property you're going to purchase. Now, you can identify more than one property. I'm not going to get into that right now. But the bottom line is, by day 45, you need to be in contract on what you want to purchase. Now, you have 6 months, 180 days to really buy it, but the key is at 45 days. Now, is 45 days a lot of time? As Jean just pointed out, we just don't got a lot of inventory right now, okay? There's not a lot out there to buy. Inventory is very low. There aren't a lot of buyers, but there is not a lot of inventory. And so 45 days is not a lot of time. If you're trying to sell a property today and wanting to do an exchange, the first thing to do is don't accept a 10-day contract. Ask for 45 days, ask for 60 days. The longer the contract, the longer before escrow closes, the longer before that 45-day clock starts. So the idea of a longer or more flexible close of escrow date just gives you more time. So once you're in contract to sell your property, you can get out and start making offers on other properties. So you can go into contract to buy other property before you sell yours, as long as the one that you're selling closes first. Now, side note, if you want to buy first and then sell, there is something called a reverse exchange. I'm not going to get into that today. It's a much more complicated transaction. Again, in 2.5 hours, it's not going to have enough time to cover that. But there is something that does exist if you want to buy first and then sell. By the way, just to let you know, I had a very strong cup of coffee for lunch today. I'm sorry, and I know I'm talking fast. My apologies. So anyway, it does exist. The 45-day clock really is the critical thing. All right, next thing, how much do you need to spend in the property? The answer is very simple, all of it. It's not the profit, it's not the equity, it's everything. If I sell for $1 million, you need to buy for at least $1 million. Now, can you buy for more than $1 million? Yes. Can you buy multiple properties that add up to $1 million? Yes. Can you buy for less than $1 million? The answer is actually yes. But you pay tax on the difference. Sometimes you'll hear people talk about boot. Boot is what you pay tax on. So if I sell for $1 million but only buy for $900, that $100,000 it becomes taxable. That's referred to as boot. So if you want to learn a little bit of lingo, that's your lingo for today. So, but as a rule, if you don't want any boot, you don't want to pay any taxes, you want to buy equal or more in value than what you sell. Part 2, equally important, all the cash, all the equity that came from that sale, all has to go into the next property. Any cash that you have left over on the table, you pay tax on. So you need to buy equal or greater and use all the equity towards that next property. Obviously, many of us own our real estate. We have a loan on them. When escrow closes, that loan gets paid off. But if I sell $1 million property, it has a $300,000 loan, then there's $700,000 in the exchange account, but you still need to buy $1 million property. So you still have to make up that $300,000 of debt that got paid off. Now, for most people, you're just going to get another loan to pay that off. But if you want to use your own cash instead, that's okay. There's a common misconception in 1031 that you have to replace debt with more debt. That's not true. You can replace debt with your own cash. That's perfectly okay. So the key things to remember is equal or greater and use all the cash. Now, in summary, that really is the 1031 exchange. You're selling investment real estate, you're buying investment real estate. Got to know what you're going to buy within those first 45 days. You got to spend all the money, but otherwise it really is not a complicated transaction. I always say the main thing to know is to understand the rules, understand what you're getting into before you list the property so that once Gene finds a buyer for your property, which will be very quickly, then you already know what you're doing, hopefully what you're going to be buying in replacement. Now, let's talk about some strategies, because a lot of you don't have investment real estate, but you have something that's even more valuable, your primary residence. So let's talk about exit strategies for your primary residence. Now, how many people in this room have owned their house more than 27 years? Oh, God. Guess what? The law has changed. 27 years ago, when you bought your house, you had to go buy another house. As long as I kept buying a more expensive house, I kept deferring my taxes. And that used to be called a 1034 exchange. That's gone. In 1997, they completely eliminated that. Now, when you sell your primary residence, it doesn't matter what you do with the money. If you're single, you get to keep the first $250,000 of profit. If you're married, you get to keep $500,000 of profit. And if your gain is more than that, you're paying taxes. Now, one thing to remember, in 1997, that was a lot of money, even on the peninsula. Not anymore. Now you own your house more than a few years, chances are very, very much that your gain on your primary residence is going to be way in excess of that $500,000. So, what do? I don't want to write the 6 or sometimes a 7-figure check to the government in taxes. What can I do? A couple of things. Number one, is there any portion of your property that's considered to be an investment? Do you have an ADU? Do you rent out the basement? Do you have a home office? The key is this. Do you declare on your tax return that a percentage of your property is business or investment real estate? If so, then whatever percentage of the property that you write off as that investment portion, you could do an exchange on that portion. So in this example, you're selling $1 million property, 20% of it you're writing off as either an ADU or a home office. Then 20% of the sales price you could do a 1031 exchange on, and the other 80% you still get your full $500,000 exclusion against. So it is a way for you to take advantage of both the tax rules at the same time. This is becoming more common, especially on the peninsula, because there's a real trend right now for people to build ADUs. I just set up an exchange for a woman this morning. She has 2 ADUs on her property and a home office. 55% of her house is considered, by her accountant, is considered to be investment real estate because 55% of the square footage is used not for primary residence. So she was able to do an exchange. It's a $5 million sale, so she still has a huge gain on the primary residence side, but she's able to save literally probably $500,000 in taxes because she's able to say that most of her property actually is in business or investment real estate. All right. The reality, though, is most of us do not have a home office. Most of us do not have an ADU. So what do I tell you to do next? Move out. Turn your house into a rental property. Now, after you've been renting out the house for a couple of years, is that house now an investment property? Is it still a primary residence? Yes, it is. Because what's the rule? Next. Next. Oh, one more.
Sorry. It's not, yeah,
There it is.
sorry.
Because you still meet the criteria of having lived in the property 2 out of the last 5 years. That's the IRS definition, not the IRS, tax code definition under section 121. You've lived in the property 2 years out of the last 5. So if you sell the property today, March of 2024, you look back to March of 2019, did I live in the property at least 2 of those years? If the answer is yes, you get to take advantage of both tax rules at the same time. So you sell your property for $3 million, you pocket $500, assuming you're married, and then you could do an exchange on the remaining $2.5 million. This is a very common tax strategy. And I've been literally preaching this for 20 years because I think it's a fantastic solution, and we're seeing this more and more. I probably been setting up 2 or 3 of these every single week. I did one this morning, okay? Now the key here is this does not work for everybody. If you need the money from your house to go buy a bigger house, it doesn't work. But if you have the ability to go buy another property, or you already own another property, or you're moving into your kids, or maybe you're moving to a senior community or assisted living or something like that, this is a good tax strategy for you. It is able to save you sometimes literally 6 or 7 figures in taxes. Now, the other thing to remember though is you are doing an exchange on everything minus the exemption. Because remember, if I sell a rental property for $3 million, I need to go buy at least $3 million worth of property. In this case, you get to keep the $250 or $500, but whatever's remaining has to go into the 1031. It's not just that excess profit. I did an exchange once for a gentleman. He sold a $20 million house. He was single. He only got to keep $250,000 and to do an exchange on the remaining 19.75 because he had rented it out for a couple of years. So anyway, this is a good strategy for people who have highly appreciated primary residences. All right. So again, the key here is you need to rent out the property. You need to sell the property before you moved out 3 years, because once you've moved out 3 years, now you can't say you've lived in the property 2 out of 5 anymore. So that doesn't work. All right, next. Next, yeah. All right. All right. So let's go back. Before we go there, I should have a pause slide in there. Why do people do 1031 exchanges? To defer taxes is the wrong answer. The easiest way to defer taxes, don't sell it. Sit in your butt and watch television all day. Okay? If you're watching television, you're not selling your property, you're not paying taxes. The reason you do an exchange is because you want to buy something better. Now, what does better mean? Better means whatever the heck you want it to mean. It could be, I want property with better cash flow. It could be, I'm moving to Arizona, so I'm moving my rentals to Arizona. It could be, I want to retire into Hawaii, so I'm going to do an exchange into a property in Hawaii, rent it for a few years, and then move into it. It could be, I want to sell my 3 houses to buy a shopping center. It could be, I want to sell my shopping center to buy 3 houses. A common exchange people do when they get older is they do 1031s for estate planning purposes. I love people who do this because I think it's very smart. Most people think that when they die, their kids will figure it out. No, they won't. They're going to fight over it, whatever happens. I had a gentleman last year, 95 years old. He calls me. He says, I have 3 daughters who hate each other. I have a $6 million asset. I'm doing an exchange. I'm buying 3 $2 million properties in my trust. Each one knows exactly what they're going to inherit. They're not going to fight over it. They use the 1031 as an estate planning tool. Love that idea, okay? So the idea here is you do an exchange because you want something better than what you own today. But that term better is subjective. It's what you believe it means. Now, for a lot of people, especially when you retire, you are tired of owning real estate. You're tired of managing real estate. So one of the things we look at often for people when they get older is an exit strategy. I want out of this high maintenance asset to something easier. So what do I do? There are a couple things that you can do if you want an exit strategy. Obviously, you can just sell it and pay the taxes. One, I think, a very underutilized strategy is called seller financing. Seller financing is where you act as the bank. Okay? You sell a $1 million property, they give you 10%, 20% down, whatever you want, and you get payments for 10 years, 20 years, 30 years, whatever you want. My father actually did this. When he retired, he goes, I'm done with real estate, I'm going to sell it off, and he carried a note. And the guy who bought his apartments from him had payments for 20 years. My father received a check every month for 20 years. The good news about that is you only pay taxes as you receive the money. So that's why it really stretches out your tax bill. So I think seller financing personally is a very underutilized tool when it comes to real estate. Now, there are a couple of 1031 strategies, though, that still work if you want an exit strategy. A common one is what's called triple net or net lease real estate. That's where you buy a McDonald's, you're buying a Jiffy Lube, you're buying a Walgreens, you're buying a building that you are leasing to a major corporation. I've even seen post offices, DMVs, university buildings, okay? Properties that you are leasing to a major tenant. Often these come with 20, 30, 40, I've even seen 50-year leases on these properties. So the key here then about them is you do not have to do any of the management, you do not have to do any of the maintenance, you do not have to pay the taxes, you do not have to pay the insurance because they pay it all. It's called triple net. Very low work on those properties, and they're very long-term leases. They're often referred to as checkbook type transactions because you just get a check every month deposited to your bank account. There's also something where a lot of times people will buy a fraction of the property. We used to call them tenants in common. Now they're typically referred to as a Delaware statutory trust. It's a fractional piece of commercial real estate. So I don't want a Walgreens, I want a Walmart. But Walmarts are $50 million. So what do? I buy a percentage of that property. There are companies out there who buy a large $50, $100 million apartment building or a large industrial center or whatever, and they'll sell to you in fractions. And you can buy as little as $100,000 worth of a $100 million asset. It's called a DST or Delaware Statutory Trust. Again, the key here is it's professionally managed and you just get a check every month. Now, it is still invested in real estate. This is not a security. This is not a guaranteed income. You are still invested in a piece of real estate, but instead of owning 100% of the property, you own 1% of the property, or sometimes even less. But it's a common strategy people use when they're looking for an exit strategy. It's not for everybody. It is not a liquid asset, so you can't sell it whenever you want. You're typically stuck for 4 to 8 years until these properties are sold again, and you can re-up to do whatever you want at that time. You would do another 1031 exchange. But it is a common strategy people have if they are looking to get out of actively managing real estate. And I would say 90% of the people I see go into these are 65 and older, retired, looking to make life easier for in terms of management. So anyway, those are just some of the exit strategies that we talked about. Now, another strategy that used to be common is I want to move into my rental property. This is no longer a good tax strategy. Okay, I had a gentleman when I started in this business. He was literally in the middle of moving into all 7 of his rental properties. He wanted to move in one, live in it for 2 years, get his $500,000, move into the next one, live in it for 2 years, and my wife would have left me a long time ago. But Congress changed that law in 2009. Now, when you move into a property that was a rental property or a second home, you have to pay taxes for the years it was rented out before you moved into it. So if you lived in the property, I think it's the next one. Yeah, so in this example, you rented out the property for 6 years, you move in, live in it for 3 years, you've only lived in the property 1/3 of the time, so you only get to keep 1/3 of the capital gain. Okay, so the key to take away about this is, it used to be a good tax strategy to move into your rental and sell it in 2 or 3 years. Now it's not a good tax strategy. Now, if you want to buy a property that you want to move into later and live in for many, many years, maybe even the rest of your life, that's a good tax strategy. That's why I see a lot of people exchanging into places like Scottsdale or Tahoe or Hawaii, where they want to retire to and live there the rest of their life. That's a good tax strategy, but the idea of just moving into the property, living in it for a couple of years, bad idea now. Another strategy, I had a woman once, she did an exchange. She sold her house in Palo Alto. She went to Las Vegas, about 20 houses. But her idea was, I have no retirement income. And if I need money, I'll sell one house. So instead of take the entire tax hit at once, she's bought 20 houses. I'll sell one per year, pay a little bit of taxes every year, and stretch out her tax bill that way. I thought it was a great strategy. If I don't need money this year, I won't sell it. So that's another tax strategy, is buy multiple properties and sell them off one at a time. So anyway, bottom line is there are other strategies for people when they have real estate. So first off, renting out part of your house, converting it to an investment property. Again, like a home office, you can have a portion of your property be rented out. The key there is, though, is that it's usually going to be a very small percentage of your house is actually rented out. It's not like I have a 3-bedroom house, I rent out 2, so 2/3 of my house is rented. That doesn't work that way because you get to use most of the house also. So it's only the parts that are completely dedicated to the home office or to the rental portion that is considered to be the percentage that's rented out. Joe, is that?
Right, yeah, that's right. And I think in the last 10 or so years, I've had a couple of clients who rented out rooms like Airbnb and such. So, I mean, there are different uses now, that and obviously the ADUs, that situation, that increases the percentage of your house use. But the answer that went with this said that that didn't work, but it actually does.
Yeah.
So it's a number, I think it's on page 44 of your thing. It should be, the not should be crossed out.
Yes.
Yeah. You go 2 more?
Yeah.
Because actually the next question is a good one. Vacation home and second homes.
Yeah.
As we talked about, second homes are not investment real estate. They are also not your primary residence. So they do not qualify for anything. Now, most of you are thinking to yourself, I don't have a second home, but you do. You know why? Because your kids are living there. Oh. If you have a family member living in a property and they're not being charged market rate rent, it's not considered investment real estate. It's considered to be a home for personal use, i.e. a second home. And so if you finally kick the kid out and sell it, you pay taxes on every single penny of capital gain. Now, a vacation rental, like Airbnb, VRBO, does qualify, but property that's solely for your personal use does not. Okay?
That's right.
So you have to be careful about that. A common strategy is, if you have a second home, convert it to a rental property. Rent it for a couple years as either Airbnb or a full-time rental. After a couple of years, you've now seasoned the property on your tax return as a rental. Now you can do the exchange into another piece of investment real estate. I had a couple I did an exchange for. They had a house on the beach in south of Capitola, and they just didn't go there anymore. The kids were in college. They just didn't go to the house anymore, and it was literally sitting empty. So they were going to sell it and write an $800,000 check to the government. So instead, we talked about this. They rented it for 2 years that year, for 2 weeks that year, 2 weeks the next year. They sold the property and bought a house up in Aspen. Did the same thing, rented it for a couple weeks for the first year, a couple weeks the second year. After that, they converted it to a second home, and basically they did not have to give the government $800,000 in taxes. So
maybe go a little bit more on that with the 2 weeks a year.
Please.
Yeah. Go,
so go ahead.
Go ahead. No.
So how long does the property have to be rented for it to be considered a vacation rental? I call the 2-2-2 rule. The IRS has actually given us what they call a safe harbor about it. You must rent it a minimum of 2 weeks per year. That's all. But you and your family cannot use it for more than 2 weeks per year. And you must do this for 2 full calendar years. So for at least the first 2 years of ownership or last 2 years of ownership, you got to rent it for at least 2 weeks. Don't use it for more than 2 weeks. And after that, 2 years, you can do whatever you want. Now, most of you are thinking, well, how do they know? There's a realtor right here in San Mateo who I spoke to about a month ago. Guess how they busted him? His visa bill. Oh. Guess how they busted somebody else I know? Their phone bill. No, PG&E, the thing about PG&E is they can see, when the property is being used. So if there's any time of use, they can see that, there were people here more than 2 weeks. You're not declaring the rental income, possibly. But for you specifically, I also know of somebody who got busted because they went to the golf course next and saw how many tee times the guy had scheduled. Okay? Can the IRS find out about it? Yes, they can find out about it. Yeah. Can they ask the neighbors about it? Yes, they can ask the neighbors about it. So, yes, they will find out. So, just follow the rules.
Yeah. If you're doing the second home too, and of course it's in that middle space where it doesn't apply, well, then strategize it and do something different that makes it then apply. Yeah. So, this is where your tax professional could really help. And you got to think 2 or 3 years down the line. And really the bottom line in all this is this. Is it really worth it? Okay? And like Ron said before, you could save, I have clients, we've saved $600,000-$700,000 in tax. So at the beginning, 3 or 4 years before this happened, we had this conversation. I tell them, okay, you got to do this and you got to do this. And the wife and the husband, and they were like in their mid-50s, so almost 55, so they would have been 55 then. And they were kind of shaking their head saying, that's just too much. I said, well, listen, let's put it this way. If you're going to save, $600,000 and it's going to inconvenience you for say 5 years, that's the same as the IRS saying, we're going to pay you $120,000 a year to be inconvenienced. And I said, what can you do with $120,000 a year? You have 3 kids that are entering college age. Gee, that's your tuition. So the IRS is paying your tuition by you being inconvenienced, doing a little bit of planning, getting it done, and in the end, you're right back where you started, but the IRS paid your kids' tuition. So it really depends for each person in your situation. Is it worth it? What are we going to potentially save? And is it just too much of a pain to do, or are we willing to do the work? And like Ron said, if it's only a couple of weeks a year and the place is going to be vacant otherwise, all right. But still, that's a lot of money potentially to be saved and to walk away from. To me, I just think the exchanging is the way to go.
I always view it as with enough planning when it comes to your real estate, you can almost get anything done. I say almost, a couple things that you can, but I'm not going to get into that. But you can almost get anything done with real estate. Another thing, and we didn't talk about this today, but let's say does anybody here own real estate with somebody other than your spouse? Okay, a few of you do. If you own real estate with other people, if you own it as tenants in common, and you're sick of each other, you can sell, each of you take your own share, go do what you want. But if you own it in some kind of LLC or partnership, and you want to go your own separate ways, guess what? You can't do it. You got to plan. You got to get the property out of the partnership. Then, after a few years, you can do an exchange.
Yeah.
So those are the kinds of things that you need to look at what you have, discuss where you want to be with your assets, whether it's owned individually, owned with other people. And again, with enough planning, you can almost get anything done. It might take a couple of years, but I've talked to clients literally sometimes 2 to 3 years before they do an exchange, just to get them planning on what they want to do. 2 or 3 years later, they call me back up and we actually do their exchange. It's happened multiple times that way. With enough planning, you can almost get anything done. Can you exchange from a rental house to a rental mobile home? The problem is a mobile home is almost always viewed as a vehicle, not as real estate.
Yeah, personal property.
So it's called personal property.
And that's what Ron was talking about before, that they changed the law in, was it 17?
17, yeah.
That you can no longer change personal property for personal property, only real estate. When you have that kind of mobile home, who are you paying your registration to every year? DMV. You're paying it to the DMV.
DMV, yeah.
It just shows you it's not real estate.
Yeah, so unfortunately, mobile does not qualify. I was asked the same question about houseboats. Same thing with houseboats, it doesn't qualify.
Fees or not fees to IPX.
The cost of a 1030 was nominal. It's $1,000 when you sell and $250 when you buy the next property. That's it. Yeah, it's a nominal amount.
So just to be clear, I think I understood this. So if I sell my primary residence and we rented it out for 2.5 of the last 5 years, so it does qualify as a rental. But then I sell it. The next property I buy has to be a rental for at least 2 years.
The tax code does not say how long a property has to be rented out for it to be considered investment. And I don't care what you read on the internet, there is no black and white answer to that.
That's right.
Okay.
Let's be clear though. Your rental property isn't rented for half the time. It's rented for the last half of the time.
Right.
The last 2.5 years. You can't rent it out, then move back into it, and then 2.5 years later sell it, because at the time you sell it, it has to be a rental.
Right. The day you move back into the property, it stops being investment.
So I want to be clear that what you were saying, the semantics is very important.
Well, that's a very big difference.
Yeah,
It's back in our house.
And that's why I stopped you. Right.
So that doesn't count. So we need to move out.
Move back out.
Rental again.
Right.
Correct.
Then
That's right.
sell it.
Well, okay. So, all right, let's go back.
Put you on the spot.
All right. The reason why we have this 2-year thing is because there was a revenue ruling a while ago that the IRS gave this nice example. This person moved out, and 2 years later they sold the property and they did the exchange and everything was hunky-dory. So from that little revenue ruling, which is not law, we've all gotten to the point where we said, okay, we know 2 years is okay. Okay? To me, I would say 15 to 18 months minimum, and important, the passage of a calendar year. So what I don't want is a sale in 1 year and an exchange, and then in the same year have the conversion. So I want there to be at least a year in between where a tax return is showing nothing but a rental.
And let me add to that a little bit. Sometimes the IRS, when they give us these revenue procedures, in the one he gave out was perfect. They used an example of 2 years. Never said it had to be 2 years. But when it came to the vacation rental, there they specifically said must be 2 years, because there they called it what's called a safe harbor.
Yeah.
If you follow this safe harbor rules, we cannot challenge you. You're good. So when you hear the word safe harbor, you want to focus on that. But if it's just an example, there's a lot more squishiness to it.
Yeah.
Than,
Safe harbor actually kind of protects you from.
Exactly. Safe harbor means follow these rules. We cannot touch you.
But safe harbor generally means that there's a law involved.
Yeah.
Okay? There's no revenue ruling safe harbor as far as I know. It's law. So the harbor is there for you, and you can use it, and the IRS can't come back later and say, well, it was just a revenue procedure, revenue ruling. It's law. So that's good. Whereas the revenue ruling I was talking about isn't law.
Right.
Yeah.
Yes.
So, bring back to your example. So if
You do what we were talking about. You move out, rent your place out. 2 years later, you sell it, and then you rent out the new house because, again, to make the exchange. And then after the 2 years, you move into it. And she's asking if we could do a Prop 19. Well, first of all, there's a 4-year period, and the Prop 19 only gives you 2 years. Okay? So the Prop 19 won't work in that situation.
Yeah.
Now-
In property 19, you have to buy the property as a primary residence. Whereas in this example, you're buying it, has to be an investment property because it's a 1031 exchange. So it's apples and oranges. So that's why it doesn't work.
In the example I was given before it says 2 years before and 2 years after. So if you buy the property that you want to move into and then vacate your home and rent it out, if, say, 18 months later, you sell that house, it's still within the 2 years. You bought your replacement residence for living within the 2 years. Can you do Prop 19, go back to that? And I'm saying there's a chance you can. You got to talk to the county. So what you have in that situation is you use Prop 19 for your new home, and you actually did a 1031 exchange to hide the gain, to defer the gain, excuse me. Yeah, that's right. Yes.
Yeah, hiding is a good word, too.
We're not hiding.
And by the way, just so you're clear, when you move out of the house, that's not when you start the 3-year period. Okay, I'm sorry. It's not when you rent the house out that you start the 3-year period. It's the day that you vacate. So if you vacate your house on January 1st and you paint it and you fix it up and you do this and you do that and you rent it on March 1st, you're already 2 months into your 2-year period. That 3-year period, I should say, for you to be able to sell it and defer and take your $500,000 exclusion. And by the way, it's interesting. I would say in about 25-30% of the times when I have somebody do this, at the end of the 3-year period is approaching, we have this conversation about, okay, we've got so much more time to sell the property, get your $500,000 out. You would be surprised how many of them say, forget it. We don't care about the $500,000 exclusion. We like the rental property there. It's in Bay Area. If we ever want to really move back in, we can do it. The tenants are great. The property's appreciated more than we would have saved in taxes anyway. I'm just going to leave it.
Yep.
And that's a great strategy too. See, it's all about options. It's all about alternatives, leaving things open for yourselves. And I think that's the other thing the exchange does for you.
Yeah, that's a great way to look at it. It's always say after a year or two of renting it out, examine what you want to do. Sometimes you might say, I hate being a landlord, sell, I don't want it. You might say, I'll keep the property. Or you might say, you know what, let me exchange it to something that's going to give me better cash flow, and that way I still get to pocket my $500,000. There are a lot of different ways to look at it.
So thank you very much for our speakers.